Welcome, welcome to Eagle City Multifamily, where we talk all things apartments and apartment investing. And today, November 2023, I am talking about a subject of why we invest where we invest, or at least why we don't invest in some places in the country. And we'll go into that in just a moment. But for starters, this is not financial or legal advice. It's simply sharing what we do. And hopefully it gives education, it gives understanding to people that are interested in the subject and would like to know more about it and maybe invest in commercial real estate yourself sometime. This show is based on commercial real estate, in particular apartments. So we purchase and operate B and C class apartments. Simply means we don't build new apartments, and we stay out of the war zones in the really bad areas, right? So the B and C class, the middle of the road, where the working class live. I'm sorry, and we feel is the most recession resilient, because the working class live there, they raise their families there. We create great communities. We improve the communities through improving the property and doing things for the community. So Asif Kumar is on the Eagle City team. Nikki and Dr. Sanjeev Mal are also on the Eagle City Multifamily team, and we're actively looking for more properties. And so let's jump right in here for today's topic. I wanted to read an article from the Wall Street Journal. And just a minute, let me share my screen so this gets recorded so you all can see. Share my screen, and here we go. The Wall Street Journal. Signature Bank's apartment loans selling at a steep discount. About half of the bank's assets in the closely watched auction fall into the rent-regulated category. And what that means is these apartments that they're talking about, that they're selling at a discount. Well, they're not selling apartments, they're selling the loans, because the bank made loans on rent-regulated apartments. In other words, in my terms, that means apartments where the rent is regulated. Okay, so a lot of the states across the South and Southeast are not rent regulated. Okay, so it's a little more, I would say, landlord friendly, business friendly in some of these states than it is like in New York and some states where it might be regulated. And I don't know all the states and laws, so I'm going to read a little bit from this article. It's very, very good information here. A venture of two nonprofits and related fund management is poised to win an auction for billions of dollars of Signature Bank loans backed by New York apartments, according to people familiar with the matter. The venture's leading bid of less than 70 cents of the loan's face value shows how much the value of New York's rent-regulated apartment sector has deteriorated in recent years. And in my words, that 70 cents of the loan's face value mean to me that means 70 cents on the dollar. Maybe I'm not interpreting that correctly, but that's what I'm taking that to mean. A former win could be awarded as early as Monday. I'm sorry, a formal winner could be awarded as early as Monday, according to a person familiar with assets owned by the failed bank. And I think this is one of the banks that has, well, let's read on here. Excuse me. New York state legislation enacted in 2019 made it much tougher for multifamily owners to raise rents, a development that has greatly reduced the worth of these buildings. Higher interest rates have also weighed on the property's values. So that's what it means on the rent regulated apartments. And in New York, where these apartments are, they have in 2019 they enacted a rent regulation that made it tougher. It says right here, tougher for multifamily owners to raise rents, and that reduces the value of the apartments because as many people don't want to buy these apartments, at least for the price that they expected them to be worth today. The signature loan sale of $33 billion in real estate loans and other assets has been the largest commercial real estate transaction of the year. It was conducted by the Federal Deposit Insurance Corporation, which seized Signature earlier this year. About half of the bank's assets in the closely watched auction fall into the rent-regulated category. So some of these assets are not in the rent-regulated category, apparently, by this that we're reading. The other half consists of assets backed by a range of commercial property, including non-regulated apartments. Most of the loans are performing. And what that means is they are good loans, they're cash flowing, right? The asset is paying for the loan, which is a good thing. That's a performing loan. A non-performing loan would be the one we just read about earlier in that rent regulated category, where the government put a rent regulation on so they can't raise rents more than a certain amount, right? And that hurts the owner, it hurts the loan, because it could then become a non-performing loan, which simply means that asset can't pay for the loan, right? Meaning the apartments that the loan is on, the apartment doesn't pay for the loan or the interest on that loan, right? So that then becomes a non-performing loan. So it's saying most of the loans are performing on this. It says the other half, right? That consists of the non-regulated apartments. In other auction activity, a partnership between investment giant Blackstone and Rialto Capital, an asset management firm, has emerged as one of the leading bidders for at least one of the pools of signature asset backed by commercial properties, according to the people familiar with this matter. So Blackstone is one of the largest equity firms in the world, and it says them and another one, Rialto Capital, are bidding on some of the assets. Actually, it says the Blackstone and Rialto Capital are, okay, let me read that again. It seems like a partnership between those two capital firms. It says in other auction activity, a partnership between these two giant investment firms, Blackstone and Rialto Capital, okay, an asset management firm, has emerged as one of the leading bidders for at least one of the pools of signature asset backed by commercial property, according to the people familiar with this project, with this matter. The prices paid for signature loans, and signature loans, I think it's referring to that signature bank that these assets were held by, especially for the commercial properties and non-regulated apartments, will provide the market critical data points in determining how far values have fallen. Laws passed by the New York State 4 years ago made it significantly harder to raise rents on apartments subject to regulation, thwarting the business plans of speculators who acquired properties under the previous laws. Many of these buyers had hoped to renovate and deregulate rent stabilized units and drive up rents. Okay, so that was their plan before these new laws, before these new laws were enacted. Excuse me. When the new regulations prevented many multifamily properties from converting to market rent units, the property's worth began to fall, a number of apartment landlords missing their debt payments. Sales of rent-regulated apartment buildings have come at sharp discounts. At some buildings where all apartments are regulated, values have fallen as much as 70%. That means they lost most of the value, like only worth 30% of what they were worth before. And so we want to not be involved in those areas, right? Because we're investing over here in Dallas, in Texas area, and the Carolinas, where Florida is a great state currently, has been, and don't see that any changes coming with that. With these states, all of Alabama, Georgia, all across the southeast here, it's has not been regulated. Don't see that in the near future, as at least. And so that's where we stay, over in the non-rent regulated areas. Okay, so Signature, reading another little bit here before we wrap this up. Signature failed in March following a run on its deposits, the fourth largest bank failure in U.S. history. While the failure had little to do with its real estate portfolio, it was one of the biggest commercial property lenders in New York region, making its unwinding of great interest to real estate investors throughout the world. So they're holding so much real estate in their portfolio that as these assets get sold off, it says it's bringing interest from commercial real estate owners to, bid on the property, I guess, bid on the assets in their portfolio. So as they sell it off, because the bank went under. FDIC also plans to retain a 95% stake in the rent-regulated pools. The agency has a statutory obligation to preserve affordability and also wants to be in a position to share in the profits from a rise in property values. So the longer they hold these, as the value rises on these assets, whoever is holding that asset will increase in value. And Blackstone's emergencies as a front runner for the commercial property assets was earlier reported by Bloomberg. And so that about wraps that up. And so anyone, if you would like to talk to me, my number is 903-951-7552. You're welcome to call or text me at that number. And also, you're welcome to book time on my calendar at chatwithherb.com. So if you just Google search chatwithherb.com, all one word, my calendar will pop up and you can book time on my calendar. And it's always good to send me a text as well. And that's the way to get a hold of me and the Eagle City Multifamily team. And would love to partner with you on one of our next deals. So that about wraps it up for today. And don't forget to reach out to me at 903-951-7552. You can call or text me on that number, and Google search chatwithherb.com and book some time on my calendar. Would love to talk with you one-on-one. So with that, we'll see you next Monday.